don't recognize who that is.
Is it the people from Causeway, maybe?
I've got one there, maybe you can tell us, but it's kind of a weird name, but here comes Jeff.
Okay.
All right, we are live.
And we have, good afternoon, everyone. This is Christina Bennett. I'm the investment chair for the St. Louis Public School Teachers Retirement System. I'd like to call today's investment meeting to order on September 18th, 2025. Sue, can I get a roll call vote, please?
Christina Bennett,
Present?
Candace Carter Oliver,
Present.
Lewis Cross,
Present.
William Heisey,
Present.
Emily Hubbard, Kimberly Johnson,
Present.
Shanice Johnson, Yvette Levy, Jennifer Orr, Bobby Richardson, Albert Sanders, Andrew Vine, and Doris Walker.
Here.
So we do have 6, so we do have a quorum.
Thank you, Sue. Next, I'd like to turn it over to Jeff and Gwelder from Mariner to take us to the next steps in our meeting. And then you'll let us know if we're going to go first with Causeway or we're going to go first with the report.
Sue, are they here? Are they?
Yeah, I see 2 people from Causeway and then kind of an unknown person. So
Okay. Well, Causeway is your internet. So we'll go with them first. I told them they had the first 30 minutes of the meeting.
Okay.
They manage an international value portfolio for you. We're not having any issues with Causeway. They manage approximately $52.5 million for the fund, and the performance has been solid. They exceed their benchmark long term. They just had one hiccup recently in the last 1 year number, but other than that, this manager has done a really good job for the system. And unless there's some questions, we can let them in.
So I'll let you give everyone a background. 2 other trustees that were on the board in 2008 or 9 when we had NASP in Beverly Hills.
Okay.
The 3 trustees went to a site visit to go see Causeway. They're like in Newport Beach or Long Beach or some kind of beach area in California. And so we did do a site visit on this manager because it was so close to our NASP conference. So they have met trustees outside of their initial mandate, which has probably been about 20 years for now.
Oh, wow. Nice. Yeah. And they've done a good job for you all. Looks like you've had them since, 2005. So it's been a
Right. And we did put them on watch list years ago for not adhering to the minority brokerage program. We actually let them go because they refused to comply with it. And then NEPC came back and negotiated with them once we played hardball, and they came back and have been really good since then. So they've been a good manager for us.
good. Yeah. See, I was going to say that they are adhering to that mandate since we took over the relationship for sure.
So any other questions before we bring them in? If not, let's go ahead and bring them in and hear what they have to say.
Hello, everyone.
Taylor.
Can you all see and hear me okay?
yes,
Fantastic.
there's 2 of you here from Causeway. Were you expecting anybody else?
Yes, Alessandro Valentini has joined us.
Yes.
Alessandro is one of our portfolio managers.
Hello, everyone.
And was there anybody else or?
Just myself and Alessandro today.
Okay, very good.
Great.
I have your presentation, so you can just tell me how you would like to advance that.
Okay, sure. I'm happy to share my screen if that works for you all.
Yeah, I'm good. I'm good to do it. So whenever you're ready, just let me know.
Okay. Oh, great. You can show the screen. Okay, so yeah, go ahead and pull that up. That sounds great. Well, really excited to connect with you all today. My name's Taylor Allen Lee. I'm a relationship manager at Causeway. I'm joined by Alessandro Valentini. Alessandro is one of our fundamental portfolio managers. His specific areas of research coverage are healthcare and insurance companies. But one thing about Causeway is we have a team-based approach. So Alessandro is very well versed in all the stocks in the portfolio, and we'd be certainly happy to speak pan portfolio today. And we're really excited to connect with you all. We've actually been managing an international equity portfolio for the plan for 20 years, which is incredible. 20 years is a really long time in this industry. 20 years ago, nobody had ever heard of Zoom or generative artificial intelligence. It's a long time, and we're delighted to report that we've added value for the plan participants. During that 20-year period, we've outperformed the benchmark net of fees over 3, 5, 10 years, as well as the since inception timeframe. So happy to report that, and really appreciative of the confidence that you all at the plan and also Guelda and the team at Mariner, who have known us for a very long time as well, have placed in us, and the confidence to manage assets for your participants. So thank you for that. And like I said, excited to connect with you all today. I know it's almost 4:40 there Central Time. I think we were planning to wrap up by 5 o'clock Central Time, but we're flexible if you'd like us to go a little shorter, a little longer. Does that timeline work for you all? Great.
That's fine.
Okay, perfect. And please do jump in at any point with questions. We're happy to field any questions you have during the presentation. So I'll start off with just a high-level overview of Causeway and our firm and touch on performance. And then I'll turn it over to Alessandro to talk about how the portfolio is positioned and the opportunities that we're seeing in the environment today. So with that background, Sue, why don't we go ahead and turn to page 3 of the presentation? And there's really on this page 3 key points about Causeway that I'd like to leave you all with. The first is that we are an equity specialist, and we exclusively focus on global equities for our clients. And we believe in value investing, which means that we are looking for stocks that are undervalued relative to what we think fair value is.
Taylor, one moment, please. Doris, can you put yourself on mute, please?
Yes, ma'am.
Thank you. Sorry, Taylor.
Sure. Great. So we're really focused on stocks that we believe are undervalued relative to what fair value is of the company. And we think that investing in those types of stocks will ultimately benefit our clients over time, which has been the case for your plan. Secondly, is we have an experienced team. So our firm was founded in 2001. We had several members of the team that actually worked together at a prior firm in the 1990s. So we've actually been managing international equities for over 30 years. And we think that experience helps us make better decisions for our clients who ultimately benefit from that in the form of better risk-adjusted returns. And the second point related to that is that we're an employee-owned organization. So all of our portfolio managers and several of our research analysts own shares of Causeway, and we think that's contributed to the stability within our team. The third point is that we integrate fundamental and quantitative research. So fundamental research, that is really what's driving this portfolio primarily in terms of bottom-up stock selection. So Alessandro and our colleagues in research are spending time with company management teams, understanding their business inside and out, understanding the industries that they're operating in, understanding opportunities and risks, and using all of that information to put together a price target for that company, which is what we believe fair value is for that company 2 years from today. And that's a key input into our process. In addition to that, though, we marry that with quantitative risk controls in the portfolio. So we use our proprietary quantitative tools to assess risk for each stock individually and for the portfolio overall. And we think that integrating those two together ultimately results in better returns and better results for our clients. So those are really three key points I wanted to share. So we can go ahead to the next page. Thank you. Just to give you a snapshot of our business, this is the end of August. I mentioned we had 65 billion in assets under management. We have 9 different strategies listed on this page. The largest in terms of assets is the strategy that you all are invested in, the International Value Equity strategy. You'll see that with 49 billion. We also manage global equities as well as emerging markets and international small cap. And I think it's also instructive to see the types of clients that we manage money for, the types of peers, some of your peers that we work with. So if you turn to the next page, Sue, this is a sampling of the clients that we work with, and there's 2 key points on this page. First is we have a diverse client base. So we work with different types of clients: public plans, sub-advisory, corporates, union multi-employer, nonprofits. And what that does is it contributes to stability within our overall business, because we're working with several different segments of the institutional investment industry. And the second point I like to highlight is that those long-term partnerships. You'll see St. Louis in the middle there in blue under Publix. You're in good company with several other peers who are also public plans, who we've also been partnered with for more than 10 years. And that's something that we're really proud of, is these long-term partnerships that we've been able to develop with clients like yourselves that have been mutually beneficial for both parties. So then turning a little bit just to a high-level overview of our team. So if you could turn to the next page. Or sorry, one more after that, actually. Yeah, page 7 here. So this gives you a sense of how we organize our research effort. I won't go into this in too much detail, nor will I go into the process in too much detail, just in the interest of time. We'd like to spend more time on the portfolio. But if you do have questions, of course, we're happy to address that. I think the key points here, you see in blue the way that we organize our fundamental research. So we organize by global sector, and each global research group is led by 1 to 2 portfolio managers who are supported in some cases by associate portfolio managers, and then senior research analysts, as well as research analysts. So I think that one of the key takeaway here is that we have a team-based approach, very well resourced, with experienced team members that are scouring the globe, looking for undervalued investment opportunities on your behalf. And then what has that produced? What has that team produced for you all? Just touching on performance. Sue, if you could go ahead to page 9, please. Here we're summarizing performance as of the end of August. You'll see that we've outperformed net of fees the core EFA index over the 1-year period, the 3-year period, the 5-year period, as well as 10 years and since inception. So we're certainly happy to have produced those results for you all, and we're working daily to try to continue to do that. One thing I will say is there are periods of time where we have underperformed, whether it's been for a year or for 2 years, where value stocks were out of favor, and that produced a headwind for our strategy. I think you as a plan and your consultants deserve a lot of credit for staying patient, staying true to your asset allocation, and sticking with the Causeway investment, which has produced over the long term good results and certainly added value to your plan participants. So we appreciate your continued confidence and patience that you've shown over the years. So with that background, those were the main points I wanted to share on the firm and the team. Any questions on that before I turn it over to Alessandro to talk about the portfolio and where we're seeing opportunities?
Hey, Taylor, I'm gonna a really quick question. So we see that you do show your results relative to the EFA value. I know in our reports and monitoring, we're showing it relative to the value. And I would imagine you're going to speak to this, at least as far as year-to-date performance, and your comment that you tend to, you're going to do better in value markets. And just looking at this performance page, this is a better value market, relative to growth, at least year to date. So I would imagine you're going to get into that as far as your portfolio construct. That's, I think, something we probably want to hear.
Yes, Jeff, I'm glad you brought that up, and I'd like to address that right now, and then we can also talk about it a bit more depth. So, Sue, sorry to jump around, but if you could go ahead to page 39. I know it's towards the back, but I think this is going to address Jeff's point pretty directly. So to Jeff's point, we do manage with a value orientation. And so what we've done is we've actually looked at performance of the strategy going back to 2001, and we divided that into periods of time where value stocks are up and where value stocks are down. So you see on the left side of page, quarters where value stocks are outperforming, and you see in blue our performance versus that core EFA benchmark. So to the point, Jeff, versus the core EFA benchmark, that we do well typically when value stocks are outperforming. However, in those strong value environments, we have historically lagged the value index a little bit in those environments. So we're a little bit more in that relative value type of category. But what that's meant as well, when value stocks are underperforming, which is the middle section there, you see that does tend to be a headwind for us versus the core benchmark, and that's the negative 2.2% in blue. But we do tend to hold up much better than the value index in that type of environment. So we do have a value orientation, but tend to be a little less volatile than the value index overall. And then what that's meant for long-term returns since inception is that we've outperformed both of the indices by about the same, by actually about the exact same amount net of fees since inception.
If I can add a couple of comments to that, thank you everybody, Alessandro, and thanks Taylor for introducing me. There's a couple of comments I would like to make, both regarding what the value index construction is and the risk profile of the value index, that will put this, a little bit into context. So when you think about the value index construction, it's done in a way where, the index is built not by the cheapest or the companies that offer the most value globally, but rather on a geographical basis, then identifying what companies are cheapest within the geography, which is not the way we approach value. We look globally at where are we finding the best opportunity in terms of risk-adjusted return. And that's why sometimes when you see periods of very, very strong outperformance, for companies that, have, that characteristics in an index built like that, it's very tough to replicate that outperformance when value strongly outperforms, the regular benchmark. The other comment that I will make, it's regarding the quality of the portfolio. When value, especially in the early stages of a value rally, when value does really well, the quality of the company becomes much less important. So you can imagine companies with very low PE ratios because they have very challenged balance sheets that were trading at very low levels of valuation, because in an environment that wasn't productive for them, they were at risk of the balance sheet, and there was risk of solvency, etc. When the environment changes, those companies rally much more strongly. In our portfolio, we focus on the quality of the company, balance sheet strength, and the ability of a company to use that balance sheet to restructure itself or withstand a cycle is very important. So you're going to have periods of time when companies with more questionable balance sheets may actually rally much more strongly, and then we wouldn't own those companies because of the quality. And then lastly, the last comment I will make, it's a risk understanding of the entire benchmark versus our portfolio. If when you look at the value index, value index at times could be 40, 50% in companies like financials and banks. It's going to be very tough for anybody like Causeway that has a value discipline that focuses on risk and, controlling the, the concentration of the portfolio to replicate that. And one of the reasons why we've lagged the value index recently is just that although we have a large exposure to financials, the value index has an enormous amount of exposure to financials that on a, under any risk lens would actually make the portfolio very, very risky. And we don't think that on a risk-adjusted return, we get paid to, to do that. And that's why when you see periods of very strong performance for value, we would outperform the benchmark, but we will probably struggle, as this chart here highlights, versus the value benchmark. I just wanted to add that to Taylor's comments.
Great. Any other questions on the firm that we can or performance we can address before we go into the portfolio? All right, great. Well, Alessandro, turn it over to you.
Well, thank you. And again, thank you everybody for having us today. I would like to go to page 8 before we discuss the performance, because I think, and I don't often speak about this page, which is really the characteristics and the snapshot of the portfolio. But the portfolio is a really interesting posture right now. And I think it's worth talking about it in the context of what we just talked about, which is the quality of the holdings in the portfolio. So let's focus on the characteristics. And I really want to focus on 3 metrics there. You have the FY2P, which is probably one of the crudest way to establish a value characteristics of the portfolio. The lower the P, the more quote unquote value the portfolio is. And that's where we should be. This is a portfolio that is in between the EFA index and the value index. As Taylor mentioned, we're relative value more than, deep value. So we should be a little bit more expensive than the value benchmark, but we should be significantly cheaper than the MSCI EFA benchmark. And that's exactly where we are. Now, what's more interesting is when you look at our price to book versus our return on equity. And what you see there, return on equity is really a measure of the quality of the portfolio. This is basically how much, does a dollar invested in a company, how much more does that return, by management action? What is the capital generation of management? And as you can see, we have a return on equity in the portfolio of 16% almost, which is significantly higher than EFA. And it's significantly higher, almost by 50% than EFA value. Now, that goes along with price to book, because the price to book you're willing to pay for a company is really a function of the cost of equity and the return on equity. And that's where it's interesting. Although we have quality in the portfolio in terms of the companies we own that is significantly above both indices, we actually have price to book that it's in between the two of them. So basically, when you compare our portfolio versus MSCI EFA, you're basically getting higher quality companies, better managers, better capital allocators for a discount to the index. And that is really interesting, because when you're seeing the outperformance of the portfolio, but you're also seeing the level of opportunity we find, that's exactly the opportunity we find. The market is mispricing these good capital allocators, these management that are doing the right thing, that are investing $1 to get significantly more than $1, and we are paying a discount to the same company, which is not as good as allocating capital as it is in the benchmark. And I think that's really interesting, because that also provides us with a significant amount of risk budget that we can use and take advantage of opportunities as the volatility we've seen in the market presents to us. So I wanted to just cover this briefly before we talk about performance. Any question on the portfolio characteristics before we talk about performance? Excellent. So maybe on page 9, we can talk about performance. And, Taylor addressed some of that. I mean, we are very pleased with the way that we are performing, the EFA index. And, it's natural to some degree, the level of underperformance that we're seeing versus the value index. And we're pleased on the numbers over the longer term. I mean, 7 and 10 years, we've been able to outperform significantly both indices. And, in the current environment, that's exactly what we would expect on a year-to-date and one-year basis, where we should be expressing the strong performance over EFA. When we look at the real drivers of performance, which is on page 12, and remember, this is a portfolio that is built on a bottom-up basis. We invest in individual companies. We don't make allocation to industries, but this is what it looks like when you think about the industry. What have been the biggest driver of that outperformance? Materials, financials, pharma, tech hardware, and insurance. So as you can see here, yes, financials have been a big driver of the outperformance, but it's not a homogeneous group. You have pharma and biotechnology and technology also being big drivers. So this is not outperformance that has come from having a very cyclical posture in the portfolio, but rather stock selection. And you really see it here. When these bars have a lot of blue, that means we picked the right stocks. That is the stock selection and interaction, which has been the biggest driver of alpha for us. Now, on the downside, you see a similar trend. Capital goods, transportation, and consumer discretionary have been the biggest drags in terms of the portfolio performance, and that has also been because of individual stocks. So this is kind of what you should expect from us, which is really what have been the drivers of performance. It's really been the stock selection and the individual stocks that we decided to invest in. And that's why, as a next step, I will point out to page 15. And I would like to cover some of the drivers of that outperformance. So when you think about, the outperformance for a year to date on the portfolio, you'll see up on top. And again, yes, you see a few financials, you see several banks, and banks have been very strong in this environment, especially European banks, which are exposed to an environment in Europe that although we're expecting interest rates to come down, the banks that we own in the portfolio are banks that actually are redeploying capital and buying back shares at very cheap valuation and generating a lot of value. And it goes back to what I was talking about earlier. The ROE for these banks is improving, and the price to book of these banks is still very low. Buying back those shares is probably the easiest and most risk-free, or let's say low risk investments that they can make. They know what their company is doing, they know the value of their company, and they're buying back shares for a deep discount to where these companies trade at. And that, creates a lot of value for shareholders. But it's not only been about banks. I mean, Barclays, UniCredit, BNP, Societe Generale have all been great performers, but you have companies like Rolls-Royce, and Rolls-Royce has been one of the best performers for a few years in our portfolio. Rolls-Royce is an engine manufacturer in the UK, had a very tough time during COVID. Their business model is basically one where they are deeply cash flow negative when they design and manufacture the engine for airplanes. And then once the airplane has the engine installed, they have a constant stream of cash flow for maintaining that engine. Every month, the airlines need to pay Rolls-Royce, a very hefty fee for maintaining that engine. And they need to have Rolls-Royce engineer maintaining that engine. Now, during COVID, when nobody was flying, those fees weren't paid because the engines weren't being used. And that put the company under a lot of stress. Management reacted by fixing the balance sheet first and then fixing the company. So they raised capital in November of 2020. They then disposed of businesses that weren't core, and then they refocused their businesses to make it more profitable. So what you've seen is when planes started to fly again, and we've seen number of hours flown now being back like significantly above where they were pre-COVID, this was a big benefit. Every item of the company in terms of profitability and cash flow generation is better now than it was before. And the market wasn't expecting that. The market was really looking at this company and assuming that, nobody was going to fly anymore. And that is really where, we found the opportunity. And this is a stock that has outperformed for us for several years. Now, the weight in the portfolio is much smaller than it used to be. This used to be closer to a 5% weight. And that is because with our process that, Taylor highlighted on a risk-adjusted basis, the ranking of the stock is not as attractive as it used to be. So we've been reducing the position. But, given what management action has taken, it's still a significant contributor in terms of performance in the portfolio. But it's not only this. You actually see household and personal products. So this is a very defensive sector that has also contributed a lot to returns. And Reckitt Benckiser is a good example of that. This is, one of the prominent company in terms of consumer health. And, they were involved in a few litigations that are really coming to play to their favor. And in addition, the fundamentals of the business are improving. And that's, clearly a stock that has provided with a lot of outperformance in the portfolio. And then lastly, on this group, I wanted to cover Carnival, which is a cruise company. And the investment thesis on Carnival, it's actually very interesting. Carnival and all the cruise operators right now are seeing record demand. What they've done in the past, these companies have actually increased CapEx. So they decided, well, we're seeing more demand for our services. What we're going to do, we're going to put more ships, and we're going to start building more ships that take 2 to 3 years to complete. So by the time those ships were completed, the demand had waned, and those were terrible investments. So what Carnival is doing this cycle, they're actually saying, no, we're going to increase utilization of our ships. So while demand is very high, they're actually, not building new ships. And that really helps in terms of the return on capital that they have in the business. In addition to that, they're actually making people pay more for experiences on board. So they're monetizing those experiences, and they're reducing the cost of acquiring customers. Rather than going through travel agents, rather than going through aggregators on the internet, what they're doing, they're reaching out to customers directly. If you've taken a cruise, you're going to get emails, you're going to get advertising for another cruise, and that is a much cheaper way to acquire customers than going through a travel agents, etc. So what you're seeing the capital allocation get better, the revenue growth improve, and the margins improve because the costs are lower. And that is really positive in terms of the cash flow generation for the company. And that's where you've seen the performance, and that's also one of the reasons why we're so excited. Now, I also want to cover a couple of the underperformers there, and chiefly Worldline, I will mention. This is a very small weight in the portfolio, but this is basically a payment company in Europe that has seen a lot of, consternation around some of their client base. And there were concerns about fraud in some of their client base, and that's driven a lot of the underperformance of the stock. Now, the company has cleaned up the client base. Right now, they've reset the client base. The market hasn't given them credit for that because they're still struggling with market share. So we're seeing the shares actually don't outperform the way we think they would. But right now they have a new management, and they actually have an investor day in November where they're going to talk about, the new plan there. And although it's a small weight for the portfolio, we're waiting to hear back from them what the new plan is there. And that could be a great opportunity because the shares have been very weak. If they can right the ship, as we think they can, this is going to be a significant outperformer going forward. And then I will mention probably Electrolux, which is a consumer durable and apparel company. Basically, this is a company that does dishwashers, washing machines, etc. And the weakness in the stock has been mostly driven by concerns around tariffs. Now, what the market doesn't understand is that Electrolux, it's actually better positioned than many other of these appliances companies because a lot of their production is actually in the US. And using imported material, but the impact on tariffs is much less than the market expects. And as such, this is a stock that we think is deeply misunderstood by the market, and that's why we're finding the opportunity. Now, the stock has been actually relatively strong, very recently, so we haven't continued to increase the position, but we think there's a great opportunity here for a company that the market doesn't quite understand. Let me stop here. I could spend the next 2 hours talking about each and every stock in the portfolio. You probably don't want me to do that. So I just wanted to stop for a second before we think about and we talk about the portfolio positioning and the outlook. If there is any one company that you're curious about, or if there's any questions in terms of the performance that you would like to ask before we talk about positioning.
I was going to ask on these stocks that haven't done well, are there any that you are seriously considering taking out of the portfolio or selling?
Yeah. I would say the biggest, I'll answer the one with, where the investment thesis, it's really, we really need to see more evidence from management. I would say it's probably Worldline. We think that they've lost a significant amount of market share. And while they've cleaned up the client base, the question is, are they going to be able, what's the plan to reacquire some of the market share into a competitive market? And that's why, we haven't increased the position, waiting to hear what management is going to say, the new management, in terms of the plan going in November. So I would say that if there's one of these that I have to pick as being, hey, this is a wait and see story, it's a show me story, I would say Worldline is probably the most clear example of that.
Okay, thank you.
Sure.
This is Christina.
Hi,
So
Christina.
I have a question on your largest contributors, right? Your absolute contributors. Some of these returns are really, really great, right? Your banks, your Societe Generale, your ING, your Bank Paribas, those are really strong European banks, right?
Yeah.
But we're in a global, I would say, catch-22. We just don't know our historical markers don't follow the historical trends, right? Like, we can decrease interest rates in the US, but yet mortgage rates went up, right?
Yeah.
That
Yeah.
makes no sense, right?
Yeah.
Or, I think we're at the beginning of a recession, but the damn stock market is saying,
Yes.
come on, let's go. So our historical measures don't apply anymore. So when you look at some of these larger absolute contributors, I see that you're looking to get rid of a large distractor, but what about on your contributors? Are you paring back on some of these on the financials because you've gotten so much gain?
Yeah, so that's an excellent question. And, our process is exactly that, is, we have a risk-adjusted basis when they rank really attractively. And a lot of these securities, we were able, for example, your Societe Generale, we were actually able to buy it in April when, the market really went into a panic. And that's why it shows such stronger returns, because it's recovered a lot from that. But undeniably, all these banks have done very well. So we've reduced some of the exposures. UniCredit used to be also almost a 5% exposure in the portfolio. So we've trimmed that position, as well as Barclays. We've reduced the position recently on strength, because on a risk-adjusted basis, they're not as attractive. Now, the one issue that I would say the one common theme of a lot of these securities, a lot of these banks, is the fact that their future and the price target that we have, which still has significant upside, is more in their own hands than in in the hands of the economy. And that goes back to what I talked about, those buybacks, etc. So, yes, lower interest rates might impact some of these banks. The Southern European banks like UniCredit are probably more exposed to that, and that's why probably one of the banks where we've decreased the position more. But really, the bulk of the value generation for all these banks, for Barclays, for UniCredit, for BNP, for SocGen, is the redeployment of capital and then buying back their shares. So unless we get in an environment where credit costs really blow out and these banks don't produce any more capital, and when you look at the risk, it's relatively low of that, because in Europe you haven't really seen a lot of loan growth recently. And if you don't have the loan growth, the credit costs, the loans that can go bad, is probably going to be relatively limited. So there's going to be a little bit of stagnation in terms of the top line. The cost side is going to be relatively stable, and they're going to continue to generate capital, and they'll take that capital and they buy back their shares for a very cheap valuation. And that generates a lot of value. And that's why we're more constructive, although we've pared down some of this position on our performance, but we're still very constructive with these banks, because as opposed to maybe other banks that are just, have done very well on expectation of the economy staying stronger, these banks have done very well because they're doing the right thing with the capital, and they're really doing self-help rather than just depending on the macro environment. And that's basically how we've invested, in banks. Basically since pre-COVID, is really buy those banks that are restructuring and they're redeploying capital in a way that it's capital accretive, rather than the ones that just depend on the macroeconomic environment.
Well, Alessandro, I'm not going to continue to ask you questions because I think I could have been a PM in a different life. But I like the discussion, and I appreciate the feedback.
Absolutely. No, I'd rather answer questions than just talk for hours about things. So I'm very happy to take any questions. But any more questions on the portfolio, on the performance before we go to the outlook?
Yeah, just in terms of time, should we plan to spend just two or 3 minutes on outlook and then wrap up after that? Does that work for you all? Okay. Great. Yeah, let's go ahead and do that then, Alessandro. Thanks.
Perfect. And maybe on outlook, and really page 20 summarizes, really the last 2 or 3 bullet points on page 20 summarize really, what our outlook. We're seeing still enormous amount of opportunities outside of the US. When you look at the US valuation, I don't need to bore you again with the statistics. US versus no US, the valuation is still enormously different. Now, US companies are better in terms of capital allocation, but the delta in valuation, it's over 2 standard deviations right now. And that's what really creates the opportunity outside of the US. What are we finding? Where are we finding these opportunities? We want to buy strong companies that have pricing power, they have good brands, they have good pipeline, and companies that have gone through some issue, whether it's, they haven't managed their business correctly or there's concerns around the cycle. That's what we do best. Identify those long-term winners because, they have, a good base business, but they're going through temporary issues. And pharma is actually a great example of that. We've increased our exposure to pharma. Right now, there's concerns around tariffs. There's concerns around pricing. We focus on buying pharmaceutical companies that have strong pipeline and strong R&D productivity. So when you look at the portfolio and the companies in the portfolio, they're all companies that have very good R&D productivity, but also companies that have very good cash flow. And the way we like to think about these companies and the opportunity is when we look at these companies, we're going to get all the pipeline of new drugs for free. And that is a little bit of how we're value investors in pharma. If you don't pay for the pipeline and there's something coming out, this is all optionality value and it's all upside. So we're seeing a lot of opportunity there. Where we could be conservative in the portfolio in terms of positioning is right now there is a lot of talk in Europe about reforms, and both on a financial basis, i.e. spending more in infrastructure, but also competitiveness and reducing some of the hurdles in terms of company being competitive. If that actually happens, that is not in our price targets. If that actually happens, there's significantly more opportunity for our performance for many of these companies that we own. We own global companies. We own companies that are exposed to Europe and other parts of the world. But if Europe really does that and improves their competitiveness, then our price targets might actually be too conservative, and there is significant amount of outperformance that we can expect for several years. So I'm going to stop here. Maybe I went longer than 2 minutes, but I want to make sure that if there's any other topic, anything else we want to cover, very happy to address it.
Great. Any questions we can address?
I'm good. I don't know about the trustees, Jeff.
No, that's great. So, just in general with U.S. interest rates coming down a little bit and what the rest of the world is doing, and we hear, sounds like China is going to start trying to follow a little suit to keep things interesting and flowing in
Yes.
their economy too. So, and that's kind of things we're looking at. But I am going to kind of go a little off script here because there is something we do know you have some China exposure. I think we might have talked to Taylor a little bit about this behind the scenes here. So there is some recent legislation in Missouri that has to deal with not only it's mainly Chinese military companies,
Yeah.
and then a whole slew of individuals that are on various lists of either being part of the Communist Party or folks that are involved in wrongdoing things of that nature. There's a ton of them. So
Yes.
we kind of have the tall order of working with managers to understand, do you have exposure to those? Are you able to identify those and cross-check things on your list to make sure that we are compliant with that? And
Absolutely.
if there is some sort of exposure that you're certainly willing to custom tailor the portfolio to not have exposure to those entities and individuals.
Yeah. Thanks for bringing that up, Jeff. I mean, there's a few points there. Yeah, the China exposure in the portfolio is very low. It's less than 2% of the portfolio. Secondly, it is a separately managed account, so the guidelines can certainly be customized. And so we're happy to restrict the companies that are on that list. I know Gweld had mentioned the OFAC list. That's a list we're familiar with. We use it actually in screening for some other client accounts. So that's certainly something we can do. If you'd like, maybe as a follow-up to this, we can just screen the existing portfolio to tell you if there's any companies in there that are on that list. I don't believe there are, but we can just confirm that for you all. And then we can await your instruction on whether you want to restrict those going forward, which is simply like an email instruction. We could do that, and then we could update our compliance system and ensure that those stocks are not purchased in the account going forward.
Right.
So
And
this
that's
is
exactly the
Christina.
process we're going through. So we are
Okay.
going to be sending out communication to
Yeah.
you all and the rest of the managers that the system deals with to do just that. To number one, confirm and identify if there is anything, and to let you all know that if you do, you have to divest from those, and on a go forward basis cannot have exposure to those. So we will
So
something.
Taylor, are we, and refresh my memory, we are not in a SMA account, right? Or are we in a commingled?
You are in an SMA. It's a separate.
Okay, so we have the
Yes.
flexibility, just to let all the trustees know that it's a separately managed account, which means we are the only investor in this account. So we can, because of our volume size, right? Sometimes with smaller allocations, we can't do this.
Correct. Yes, because of your
Our
size, you have a
size.
separately managed account and you can customize your guidelines.
Yeah.
Yep.
Yes, we can customize the guidelines, and we're able to do that. And that's why Jeff was saying we can work with excluding something before we get the acts here in Missouri to do it. We can be proactive and really just work with each of our managers to see where.
That's absolutely right.
Potentially. Yeah. So it's just our potentially restrictive guidelines here in Missouri. But I just wanted to explain that because not every trustee has an investment background. So I just wanted them to explain that we have the ability with your company, and given the 50 million that we have, that we're able to customize what we need to be in compliance.
Yeah.
Absolutely, that's all correct. And also the last point I would add is the impact to the portfolio would be very limited. It'd be a very, very small impact, if any, given the way that we invest and the focus on developed international markets in this portfolio.
Yes.
Thank you. I appreciate that.
Great. Thank you all. Well, if there are no further questions, just wanted to say thank you again for the partnership over these past 20 years. Appreciate the confidence that you all have placed in us, and we're working hard every day to earn that. Certainly not something that we're resting on the past 20 years. We're working daily to continue to add value for your plan. So thank you again. And we'll look out for any correspondence on the China topic.
Thank you both.
Thank you, everyone. Bye-bye.
Thank you.
Bye. Any questions for Jeff and I before we move forward?
None here.
Well, what we have left is the performance report, and Jeff's going to do the economic overview and the markets. And then I will finish up with a flash report.
Fantastic. Sue, if you want to pull up the flash report and jump to the first page. Great. So here is a snapshot of everything that happened in August and how that's impacted the longer term numbers. And the long story short on that is, despite things we're hearing going around with tariffs, and we've started to see some softer points in the economy as far as jobs numbers and some real estate numbers and things like that, we're still seeing a fair amount of confidence from not only consumers, but just the market participants in general. So you can see a nice solid month I'm looking at that top left chart, the S&P 500. Those are the large cap stocks here in the US, the big names that we all think of, the Microsofts and Coca-Colas and that fall into that category. So nice, strong month. And as you go down that list, Russell 2000, those are those small cap stocks. So remember, we're starting to see a reversal in some of these trends. Small cap that's been out of favor for quite a while is now seeing some interest coming back with just a general flow of moving away from things that have been overvalued quite a bit. All of these high-flying tech names and AI, and looking for things that have now been out of favor. So that really rings true in two areas, not only those US small cap stocks, but also in the international markets. And you can certainly see from the numbers that we saw from Causeway and where they are on a year-to-date basis, it's been very favorable. So again, just focusing on that second to last line in that top left chart, which is the MSCI EAFE, that is all of the developed international stocks, so that excludes the emerging markets. And you can see where that's been on a year-to-date basis. So now solidly ahead of all of the US categories for stocks. So just that's diversification. That's a lot of investors out in the world saying, let's rebalance things, let's move away from the real expensive, and let's go into things that have been out of favor for quite a while. And so we've even seen a bit more of that snapback as well in emerging markets. So the emerging markets have trailed the developed markets, but they're, for the year-to-date basis, still ahead of all of the other US categories. So again, what the world generally reviews or views as one of the riskier areas of the market, there has been a significant trend of asset flows to those categories. So again, you can see not too many places over the past 12 months and 3 years and 5 years that have disappointed. So with the exception of the emerging markets, on a 5-year basis, everything's been in the double digits. So it's been a really good place. Certainly it's been from a strong economy, and I think some pretty good management of interest rates and inflation. But that's where we're running into a little bit of a problem now, and that the Fed is paying a little bit more attention to those economic numbers now, the jobs figures and consumer spending and that slowdown there. And so they're saying we probably need to get ahead of that. So that's why we saw that rate cut yesterday, that 0.25% or 25 basis point rate cut, to start to get ahead of that, despite the fact that the inflation numbers just haven't come down. And we all know why the inflation numbers haven't come down to the extent that we've wanted, and that is that flow through impact from the tariffs. So if it's it's costing them more to do business, they are passing that along to consumers. And as long as consumers still have an appetite and they're spending, that's creating that little extra inflation that's going to come down. But I think at this point, the Fed is probably resigned to the fact that they're not going to get to 2% inflation where they want to be. So I think they're probably going to be fairly happy hovering around the 3% level right now, as long as we're not completely slowing down the economy. So that's why we're seeing this new shift towards interest rate cuts, and right now what the world is pricing in and what's being signaled is that we could potentially see two more of those cuts before the end of the year. So that's what's sort of driving things, and that's why things have been positive for the past couple of months. There's an expectation that was leading up to yesterday for the past couple of months that we're going to get a rate cut eventually, and so that's kept some excitement into the markets. And then we did see the rate cut yesterday, so that's all boded very well. I think what we probably have to look out for is that if we do see the next cut and the one after that, that anybody invested in the market starts to pay attention to why we are now cutting rates. It's because we are slowing down, because the economy is starting to see some bumps in the road, and higher unemployment means folks are now not spending as much, and that consumer appetite is down too. So that's the markets will pay attention to that. So if we're continuing to lower rates, I think everybody that's invested in the stock market is going to say, let's pay a whole lot more attention to these valuations now, and probably continue to see that rotation. So let's take a look at those two, the colorful boxes to the right. And those are our styles. And remember how to read these up on top, where you see V, B, G. The V, that's value. The B, that's blend. That's the value plus growth, and then the growth G is the growth. And then the LMS on the vertical axis of that is large cap, mid cap, and small cap. So it just slices and dices and gives us an idea of how the markets have trended. So you can see for the year-to-date period on the large cap side of the equation, they're fairly similar. Growth still has a bit of an advantage, but we have started to see more of a reversal of that trend. And again, take a look at where that was relative to last year, 2024, for the full year, where growth led by quite a bit on the on all segments, large, mid, and small. 33% on large cap versus 14%. Again, 14% in any market is nothing to sneeze at, but that margin of outperformance was significant. And again, that's those high flying names, the AI and things that people are really excited about, but they're now starting to step back and take a look and say, well, yes, we know it's an area for growth. We know it's going to be around forever, but these companies need to earn. They need to get earnings. They need to grow earnings. If they can't, we might be too expensive. And so we'll probably expect to see some continuation of that rotation and more balancing out of the value versus growth. And again, also on the international side, probably we do see a little bit more room to run on those international stocks. So back to the left on the charts, the middle section, those are the fixed incomes indices. You can see again, not a bad month. It's still not keeping pace with equity markets, but again, the types of returns we've seen for the past month, 3 months, year to date are really indicative now of just the higher coupon levels for any company, or the government comes out and issues a new bond, they're issuing it at that higher level of coupon. And so we've seen that. And again, you as investors in bonds have been a beneficiary of those nice higher coupon rates. Now, what's going to happen over time if the Fed is lowering rates? Well, there's two different effects. The first is the shorter term effect, which is good for anything that's in your bond portfolio. So that means rates come down, and now the companies that are issuing bonds, or the government, they've got to issue them at lower coupons. You're holding something with a higher coupon, so that actually helps the valuation of your bond in the short term. Long term, what does that mean? It means when your bond managers are rotating and moving stuff out of their portfolio and new things in, they are doing it at lower coupons down the road. So there will be sort of a leveling effect of that, and expectation that we probably start to see lower, marginally lower fixed income returns on the long term, assuming we hold that path with interest rates. But again, still a lot to be positive about in fixed income. And again, we know why we hold those types of positions, and your managers hold those positions in the system. It's for diversification. It's for liquidity and things that act differently when the equity markets are doing crazy things. So that's why we have them there. So that's kind of it. The other thing that always, I think, stands out a little bit on this page, if you go to the charts to the right, there's currencies, and right below that are commodities and oil. And it's interesting with a lot of things that are going on in the world with what's causing inflation and what's not, and wars in the Middle East, and things that you would think would make oil and energy and gas prices a lot higher. They're not. So you look relative to where we were a couple of years ago, where the price of oil was at $80. We're now coming close to $60. And I think hopefully everybody's kind of seen that at the pump too, when they're filling it up, that we're filling up the tank on lower, and that's good for the consumer. So again, that's a factor that probably is continues to really support what consumers are continuing to spend right now, because they've got a little bit more money in the pocket, at least from what they're putting into the gas tank. So again, just sort of an interesting thing that we keep an eye on. And then to the left are just all the rates. And again, that U.S. generic government 3-month, when you hear me talk about the Federal Reserve and when they're lowering rates, that's going to be pretty reflective in that 3-month rate that we see there. So again, those shorter term rates, that's sort of the floor or the setting that the Fed says this is where the cheapest that money should be lent out at. And then if you're a company that has some credit risk, or if you're a certain portion of the government spectrum that's longer out in maturity, and it all gets sort of priced off that shorter term interest rate. So again, for all intent and purposes, we should see that come down. I know Christina did make a comment on that of, hey, we've got rates coming down on the short end of the curve, but yet our mortgage rates are pretty sticky and still high. So we'll sort of see where that goes over the next couple of quarters. In particular, we have seen a little bit of softness in the residential real estate market. So again, that's going to be markedly different from the types of real estate that the system is exposed to, but at least it's still a guidepost that folks are looking at on residential real estate. But if we went back 12, 18, 24 months from today, and anybody listed a house for sale, well, that you were going in and bidding above whatever it was listed at, or you weren't in the game. That's gone away. So we're now seeing things that are actually selling below listing price. We're seeing things that are on the market a lot longer as well. So all of these things are showing us that we're probably seeing a little softening in the real estate market. And if that continues, probably expect to see mortgage rates come down a bit, at least to sort of entice buyers to stay into the market. So I'll pause. I know that's a mouthful, and hopefully sets the stage for what gold is going to go through on the actual investments.
Okay. There are no questions. You can move to the next page, Sue. Okay, you all are accustomed to seeing this is your asset allocation page. And as you can see, there's 2 inverted triangles, the red ones, the 2 red inverted triangles. And those are the areas that we are still working with Manulife to transition that portfolio. You'll see that Loop has been funded. You'll see that in the report. But once we get the Manulife bond portfolio transition over, then those 2 segments will go away, and everything else is pretty much in line they're all within your ranges as established per your investment policy document. You can go on to the next page, Sue. As you can see here, the fund actually did well. It exceeded the return of the policy index this month, 2%. As Jeff mentioned, is a strong market in the month of August. And as you can see across the top of the page, you're having returns, or even albeit not above the policy index, 9% over the past year, almost 10% 3 years, 8% for 5 years, 10 years, 7.4, and since inception about 6.9, which exceeds the policy index. If you look down the page under that month column, as you can see, domestic equity held up pretty well, and we'll go further into that and look at the different managers. If you go drill down to the different segments of large cap, we see a core. Of course, we use an index fund, which just replicates the S&P 500. Agri-Lomax had a good month, 3.92. They're your large cap value manager and exceeded the Russell 1000 value, which brought the fiscal year-to-date number up And as you know, we've had some challenges there, but we did, as you can see, we did in the large cap value segment, the same thing we did in large cap growth. We index a portion of that to smooth out the return. And as you can see here, the index, of course, delivered a 3.2, and over the fiscal year to date, a 10%, which basically matched the Russell 1000 value. If you look at Agrolomex on a long-term basis, they've basically kept up with the index long-term, but they have had some hiccups. They are a contrarian deep value manager, so some periods they will not perform as well. In large cap growth, we have an index fund there also to offset some of the concentration that we have in the Russell 1000 Growth Index. TCW is an active manager, and they will not concentrate as the index has over the past year. It's been a little wonky. As you can see, TCW was challenged this month and delivered a negative 1.17 versus a positive 1.12. But their long-term performance can be explained by a lot of the concentration in 7 different stocks in the growth index, in some of the long-term numbers there, but still nothing to sneeze at. They delivered 16% for the fund for the time period that they've managed for you. You can move to the next page, Sue. In the small, mid-cap, micro-cap space, Westville actually did not do well this month with a 1.71 versus 5.91. They're a small cap growth manager, which has brought down their returns. The 1-year return is and coming forward has been very weak. But if you look at the 3-year, the 5-year, 10-year since inception, just slightly off in the 3, but the long-term numbers have been very strong. If you look at that since inception number for Westville, they have delivered almost 300 basis points of outperformance versus the Russell 2000 growth. Systematic represents small cap value, and this month they're slightly off, which is hurting the fiscal year to date and 1-year numbers. But if you look at their longer term numbers, no concern there. That manager has delivered nice excess returns over the index in the longer time periods measured. DFA is a quantitative micro cap manager, tend to have a bit of a value bias. As you can see here, they exceeded the return of their benchmark for the month at 7.68 versus 7.14. A little off fiscal year to date, but long-term numbers, as you can see, in every time period measured, they have exceeded their custom benchmark. Now, developed equity, we had Causeway talk to us today, which is your developed international value tilt manager. Fidelity is the growth offset for that. And as you can see here, for the month of August, they delivered excess returns over and above their custom benchmark at 3.6 versus 2.8. And the fiscal year to date, 1-year number, 3-year number, 5-year number, 10-year number, and since inception, they've outperformed every time period measured. So that pairing there with Fidelity and Causeway gives you exposure to growth and value in an international market. Now, if we go down to the next section, we're looking at emerging markets. The emerging markets manager, DFA, another portfolio, quantitative base value tilt. As you can see here for the month of August, they've delivered excess returns, a little bit weaker in the 1-year number, but the longer term numbers for them are ahead of the emerging markets index. Now, Invesco Emerging Markets Equity, this is a manager that we have been concerned with for a bit, and we're doing a search. Well, Invesco has decided to terminate this product at the end. I think it's December 15th, if I'm not mistaken. So we have a search, all the dockets, but we're trying to get clarity from the attorneys on this international exposure and what can and cannot be done. But in the interim, until we get clarity, what we're probably going to do is to index that until we can get that clarity, and then move into an active manager in that particular portfolio. And Jeff, please weigh in if you'd like to make some more comments regarding that Invesco Emerging Markets Equity portfolio. And
Sorry, trying to find my mute button. No, that's kind of exactly the process we're going through right now. So we'll the next I think at the October meeting, we're gonna probably have a solid recommendation for what we want to do with those assets, just so we have time to make sure that that's moved, or that we have a solution for it before they sort of force us out in December.
Right. And we're planning on trying to bring in a search, but we want to get clarity before we bring in a search to make sure that we don't have we don't have managers coming in and then find out there's restrictions per the legislation that's on and the legislators in Missouri. So we may just index it if we haven't received clarity by their deadline of December 15th. This page, go to the next page, Sue. We'll go into the next manager. This is your Exponus manager, managed emerging manager. As you can see here for the month, they delivered a nice return of 3.78 versus the world index 2.47. So nice outperformance there, which has helped their 1-year number, and it's pretty much in line. They're a little struggling on a 5-year. They came in 2020, but slightly below on a long-term basis, 11.68 versus 12%. You can go to the next page. And this is your fixed income. Actually, in fixed income, domestic fixed income, we've got Manulife, as I mentioned. We're still trying to move some dollars and get that finished up from that Lazard, which is down there at the bottom. We're going to be liquidating that portfolio and moving it. So you've got Manulife's above for the month, solid aggregate, Bloomberg aggregate manager. 1-year numbers are fine. The long-term numbers for this manager, they've exceeded the Bloomberg aggregate. Ernest Partners, same story there. Ernest Partners has done a solid job for you since they were hired in 2008. The new manager that I mentioned is Loop Capital. And as you can see here, in their first month and a half of management, or 2 months of management, they have exceeded already the Bloomberg aggregate index. Now, drilling down to opportunistic fixed income, the Loomis Sales Alpha Trust is pretty much in line for the month, slightly off. The fiscal year-to-date number isn't as strong. The 1-year number, the 3-year number, 5-year number since inception, that manager has exceeded their benchmark. The TIPS, of course, is a replication of the TIPS index. The Neuberger Berman Global Opportunistic Fixed Income did a good job this month, delivering excess returns over their custom benchmark. Fiscal year-to-date numbers look strong, pretty much just right on top of it on a 1-year basis. And the tough point, they're starting to turn around what was tough performance, which is embedded in that 5-year and since inception number. The Lazard EMD is the one that we are in the process of transitioning, and we just received notification today that they're having a portfolio management, is one of the portfolio managers, the main portfolio managers on that strategy is leaving. So we got ahead of that, fortunately, and that portfolio will be transitioned hopefully within the next few months. So we won't be looking at Lazard EMD going forward. And the next page, Sue, I believe is your the hedge funds, GTAA and hedge funds. PIMCO All Asset has been struggling this particular month. They came back and delivered excess returns at 3.04. The longer term numbers, starting with the 5-year numbers, are strong, but those interim periods, the last year has actually brought down some of those numbers in the 1-year time frame, as you can see there. But long term, they've exceeded their benchmark at 5.8 versus 5.4. Hedge funds, White Box continues to do well, 1.57 versus 0.92. The 1-year number is strong. The 3-year number, 5-year number, 10-year number since inception. The only weak point there was in the fiscal year to date, but long-term, that manager, no concern there. And Grosvenor, who had been performing extremely well, had a hiccup this month, 0.9 versus 1.69. But if you look at those long-term numbers for Grosvenor, that hedge fund manager has delivered great returns for the fund for the time period they've managed and all of the rolling time periods measured. And I believe the next page is real estate, which we don't report on a monthly basis. Those come in quarterly only. And that pretty much rounds out your performance for the month of August. And we are almost through the third quarter. We're within the last couple of weeks, and then we will have the the third quarter numbers, and hopefully we will looking at what we're seeing now, we will have a positive third quarter unless something really wacky happens. Any questions of myself or Jeff regarding the portfolio or Causeway that came in? No? It looks like we've given you all back some time then.
Oh, thank you, Gwilda. I have multitasking, but I appreciate it. I like the presentation today. I like the numbers. And is Bobby on? Because Bobby would be happy right now. I didn't hear Bobby today. Oh, I see she's there. She's on mute.
Yeah.
Yeah, I'm here. Well, the great report, and Jeff, you was awesome. But I did hear something we was behind on. You did mention we was down somewhere, but I know you and Gwen are gonna work it out.
Yeah. It's just that, you get some managers on some months aren't going to do as well, but I think what we concentrate on, because these are pension assets, we concentrate on the longer term returns. And so right now we don't have any concerns. And the ones that we did have concern with, actually, we're fixing all that as we speak. So, yeah, we're good.
Okay, thank you guys.
Thank you. Sue, is there anything else on the agenda that we need to address today?
Yes, so we probably need to just touch base about the meeting next month. It's October 16th. And that falls, I know, SLPS has their parent-teacher conferences.
And also my birthday.
Hey!
All right,
A
Bobby.
celebration meeting.
Yeah.
All right.
So, I don't know if we, want to look at a different date for that meeting. I know, I think Jeff and Gwilda were both available the next week, but then that pushes us past the regular board meeting. So that if we did it on the 23rd, we'd be after the regular board meeting. And so any recommendations there would have to wait till December. I don't know, Jeff and Gwilda, because we'll be getting the Invesco is going to be out, before that December meeting. So,
So Sue, our meeting is on the 16th, right?
Yeah, 16th.
But that is parent-teacher conferences, correct?
That's right.
So could we meet on because do we have any decisions that have to go to the full board?
Yeah, if Jeff and Gwilda are going to present something for the Invesco money, that
Okay.
the only
So
thing. Jeff and
So
Gwilda.
can we meet on the 9th? I know we may not have a flash report by then, right? Because that's too early for investment returns to be published, but again, we won't have September numbers by the 9th.
No.
So we might just have a meeting to discuss the Invesco. We won't have an investment report for third quarter, but we'll have to pick it up in November.
Yeah, we can provide a general overview of the markets at the meeting.
Yeah.
And we wouldn't give you sort of a ballpark of where we think the system will be for the month, and then we can, certainly as soon as that report's available, provide it to Sue and she can.
Yeah. So
Distribute.
if we were to just raise the hands of everyone today to be able to have the flexibility to meet on the 9th, is that possible?
I'm good
Yeah.
for the 9th.
And Jeff and Gwilda, are you?
Are you available, Jeff and Gwilda?
I'm not available on the 9th. I'm out of the country on the 9th. So
Oh, have fun.
A tough job she had.
Yeah.
Boy.
I know. Jeff,
You'll be here.
I'm available on the 9th.
Bobby, are you available?
Yes, I'll be coming back from the NCTR conference, but I can get in there.
Okay. William?
I think I can do the 9th. I cannot do the 16th. That's also
Okay, yeah.
our parent-teacher night.
Okay.
Correct. How about you, Kimberly?
Yes, I can do the 9th.
Doris?
Doris, you there?
How about you, Dr. Candace Carter?
Yes,
Okay,
this is Doris. I was looking at my calendar and make sure it didn't conflict with court. Yes, I'm available.
okay. I have, how about Emily and Jennifer? Are you both available?
Emily?
I'm available. Jennifer Orr is available.
Okay,
I should be available as well.
okay. So that would give us a quorum. We definitely would have more than a quorum to be able to meet on the 9th. Sue, is that okay with you?
Sounds good, yeah.
Okay, so let's schedule that and send a notice quickly to the other trustees who are not present today to be able to meet on the 9th, so that we have the ability to make a decision for the full board meeting for October.
Okay, that sounds good. Thank you.
No problem. Do we have any other business to attend to?
I don't think so.
So if not, then Bobby, can you do the honors, please?
Yes, I would like to make a great motion today to adjourn this lovely meeting on this beautiful afternoon. Good night, everybody, and sweet dreams.
Second.
All those in favor, please say aye.
Aye.
And if those who are attending the Balloon Globe, please enjoy yourself this weekend. Here, our Forest Park needs your attention and love, given the trees that were lost. So if you can have it, please enjoy this great weekend of festivities.
Thank you.
Aye.
You too.
All right, take care.
Have a good weekend, everybody.
Good night.
Bye-bye.
Thank you.